Hello, my friends. Today is August 2nd, and this is Markets Weekly. So, the past week was an action jam packed week. We got huge Tier 1 data prints, we got some Mag 7 earnings, and of course, as always, interesting stuff coming from President Trump. So, today, what I think I'll do is we'll kind of flow through some of the developments that happened the past week, but we'll place emphasis on the most important development. That is, non-farms payrolls print on Friday was disappointing, totally shifted the narrative, and is likely going to shift Fed policy as well. Okay, starting with the GDP print. Now, on a first principle basis, we always got to place a lot of emphasis on the GDP print because if the economy is growing, that means we're creating jobs, that means earnings are increasing, and if the economy is shrinking, well, that's not good. Now, the second quarter GDP print was higher than expected, with a headline print of 3%. Now, that sounds really good, but we also have to remember that the first quarter printed at a negative 0.5%. Now, a lot of the reason for the volatility is because of the trade war. A lot of companies are behaving differently, maybe importing a lot of stuff the first quarter to avoid tariffs and so forth. So let's just take the two quarters together, average them out. First half growth on a headline basis is 1.25%, which is notably slower than, say, the 2.5% growth rate we've been seeing the past few years. So on that measure, the economy is definitely slowing down. Now, a lot of people who focus on GDP prints also like to focus on this measure called final sales to domestic purchasers, which they think of as a kind of a core GDP print that isn't less affected by things like imports, exports, inventories, and so forth. Now, that measure growth is also a little bit above 1%, notably slower than last year. So the GDP data, although the market reacted positively to it, is at the end of the day showing that the economy is slower this year to date, than last year. Now, in addition to the GDP print, we also had for the markets, super important, a bunch of Mag 7 prints. Now, Microsoft and Meta seems to have beat expectations. The market really loved their print. Meta was actually up 10% the day after, and Microsoft zoomed up to be the second company with a $4 trillion market cap. Now, the other Mag 7 earnings, say Apple, market was kind of lukewarm to that, and the market really didn't like the Amazon print, with Amazon declining notably the day after. But one thing to keep in mind that stood out to me is that when the market opened at all-time highs after the huge Microsoft and Meta earning beats, the market kind of sold it off throughout the day. And so that kind of reversal seemed like kind of a red flag to me. Now, the real negative development happened on Friday when we got the non-farm payrolls print. Now, the street was expecting about 100,000 jobs created for last month. We got 70,000 instead. So that was a little disappointing. But the real problem was in the revisions, which is kind of surprising because, as we've talked about before, the market usually doesn't care about revisions, usually just cares about what happens to the headline. And when the jobs get revised away later, they just kind of shrug their shoulders. But this time, though, the market cared a lot about revisions because they were huge revisions, one of the biggest revisions we've seen in decades. Now, when you look at the job growth over the past few months after revisions, then all those good job prints we had the past month just disappears. So it seems like over the past few months, the economy has created very little jobs, actually. So that kind of makes sense when we talk about the GDP prints being showing slower growth. Then logically, job growth will also slow as well. So at least the two are consistent. So that is setting up a labor market that is much weaker than expected. Now, there's some interesting work done by Parker Ross over there from Arch showing that, although the unemployment rate is still around 4.2%, which is historically quite low, a lot of the reason is because labor force participation is declining. So more and more people who are just not looking for a job anymore, they're dropping out. It could be that they're discouraged. It's hard to know. But part of the reason why the unemployment rate has stayed so low is because the supply of labor is decreasing from lower labor force participation. And by his calculations, if labor force participation did not decline the past few months, if it held as it was in April, we'd actually have an unemployment rate of 4.9%. So that, of course, is a level that would more merit caution. So the market took one read of this print and really didn't like it. So the stock market sold off. Bond market rallied hugely. We had a huge rally in the 10-year yield, and especially in the front end, because the market, although it was, wasn't completely sure if we would get a cut in September, now is becoming increasingly confident that we will. It's beginning to price in a lot more rate cuts, and of course, the dollar sold off significantly. Now, the upshot of this is that with such a weak labor market data, there is an increasing prospect of a recession. And if you have a recession, that changes everything. Now, this kind of puts us in an interesting position because the Fed is potentially kind of late to the party if that's the case. Now, on Friday, or maybe it was a Thursday, anyway, around then, we also had two statements from the two dissenting Fed governors on why they dissented on Wednesday's meeting. Now, Governor Bowman and Governor Waller both gave basically this pretty similar rationales. Their rationale for why the Fed should have cut last Wednesday was because they thought that the labor market was just not very strong. In fact, Governor Waller gave a very clear speech why he thought it was on thin ice, that it was very likely going to crack. And so monetary policy, because it acts with a lag, we should be acting now and cutting rates now. And if you recall, this data kind of contradicts what Chair Powell was saying. Let's listen to what he said at the last meeting.
I mean, our two mandate variables, right, are inflation and maximum employment, stable prices and maximum employment, not so much growth. So the labor market looks solid. Inflation is above target, and even if you look through the tariff effects, we think it's still a bit above target, and that's why our stance is where it is. But as I mentioned, downside risks to the labor market are certainly apparent.
So Chair Powell was basing his case on keeping policy where it was, just leaving rates unchanged, because he asserted that the labor market was strong, inflation a little bit higher than expected, and so we should just leave policy where it is. And in his view, policy is only modestly restrictive. Now, with this new labor market data, that faction that believes that the labor market is weakening is going to have a lot more ammo. They're going to be a lot more persuasive. And so it's a really good chance that we do get a Fed cut in September. Now, between then and now, we have to remember that we're going to get one more labor market report. If the next report is like this report, weak with more revisions, so even revising away the 70,000 jobs we created, we could even go for 50 basis points. That being said, on Friday, we also had some commentary from New York Fed President John Williams and also Cleveland Fed President as well. And they were like, yeah, labor market is strong, but yeah, maybe we can cut it September. So they were sticking to the narrative. But I'm pretty confident that, if one more weak labor market report and they will be forced to change their mind. So in addition to this, and I think we can now talk a little bit about some interesting political developments now, we have a curious sudden resignation of Governor Kugler from the Fed. So Governor Kugler was actually absent the Wednesday meeting, and that's pretty unusual. If you're a Fed governor, your job is to show up at these meetings, right? That's kind of what you're supposed to do, but she kind of didn't go. And then suddenly on Friday sent a letter to the president saying that she was going to resign, and no one is really clear why. It could be for personal reasons. Maybe she's not feeling well, but then she's going to resume teaching at a university later in the fall. I mean, there could be some political intrigue for all I know. But that kind of moves up the timetable when President Trump can appoint a new person to the Fed board. Now, Governor Kugler's term was going to expire early next year, and that was the timetable. So President Trump maybe would appoint someone or nominate someone to take over that role in the fourth quarter, and that person then can hopefully become confirmed early next year. But now this is moving up the timetable to 6 months. Now, a common narrative was, this is obviously suggested by Secretary Bessent, was to nominate someone who was on Team Trump, have that person then be elevated to Fed chair when Powell's term expires, and have that person act as a quote-unquote shadow Fed chair once confirmed or once nominated to try to influence monetary policy. that whole playbook was not slated to start until the fourth quarter. But now that Governor Kugler is suddenly resigning, that whole playbook can be moved forward very, very soon. And so we could have a new Fed board nominee sooner than expected. So that's some more potential for some dovish moves in the markets, because whoever that person will be able to have a voice on the FOMC sooner than expected. And depending on who they are, they could be someone persuasive that kind of trying to pushes the board towards more of a dovish slant, or it could be someone that's perceived to be kind of a politicized appointee who could, of course, not be persuasive and not end up being super productive, and we just end up having 3 dissents instead of 2. So we'll see what happens. This timeline is being sped up. Now, one other thing that I would like to point to is that President Trump is unhappy with the labor market statistics, and so has directed his team to fire the commissioner of the Bureau of Labor Statistics. Now, this person is a Biden appointee, and President Trump is saying that this person is being politicized and wants to get rid of this person. Now, on the face of it, this sounds pretty bad, right? You don't like the statistics, and you just fire the commissioner, and maybe next month we'll get really good statistics or something like that. So that is something of concern. But remember, actually, we'll keep in mind 2 things. Like we've been talking about, we are in a world where the future will not look like the past. How the United States government is going to be run is going to change. So things like this are going to happen more frequently. I mean, we already see a president that shows up at the Fed, gives the Fed chair a pat on the back and asks them to cut rates, right? So things are changing. So maybe we will see more of these sudden firings to, I guess, replace them with other political appointees. The second thing is that, well, I don't actually know this person at all, and maybe she is doing a good job, and there are a lot of people on the internet who are vouching for her. But we also know that the Biden administration, they were, in a lot of ways, dishonest, right? So you had all these Biden people telling everyone that the President Biden was young and dynamic, sharp as a tack, and in command and all that. But now we know, in retrospect, that he basically had dementia, and other people were running the government for him. So a lot of these people were dishonest to us, and so it's hard to know whether or not this BLS commissioner is one of the honest people or not. So I just don't know. And so even though it appears really bad that she's suddenly being fired, I just don't know enough about the facts to know if this is a good thing or a bad thing. So, one other thing, last thing that I like to flag is that I think the market is really underappreciating upcoming geopolitical risk when it comes to Russia. So I guess the big news that actually started the week over the weekend was President Trump and the European Union suddenly reached a trade deal. No surprise to any of us, we already knew that the end game, as we discussed last week, was to have 15% tariffs on basically all of the U.S. allies. Now, one thing that was special about the deal, and this was widely remarked, is that it seemed very, very one-sided. President Trump, at the end of the day, said that we were going to tariff EU imports by 15%. You cannot retaliate. And also, you must open up your markets to more U.S. goods. And also, you have to promise to buy more natural gas from us. Definitely very one-sided. But when you look at these negotiations, we have to realize that it's a multidimensional thing. The EU depends on the U.S. for its defense. Now, if you look at this map of U.S. military bases throughout the world, you can see that there are quite a few of them in the European Union. And the European Union right now is at war with Russia. So it seems like for them, it's not just about trade, but also for defense as well. Now, reading between the lines, it seems like part of the reason that they were willing to agree to this one-sided trade deal was that the U.S. would have a bigger participation in the war with Russia. And so we see the President Trump ramping up rhetoric towards Russia over the past couple of weeks. Now he gave President Putin a deadline, 50 days to stop the war with Ukraine. Now it's been shortened to 10 days, which is sometime next week. And his promise is that if the war is not stopping, he's going to put secondary sanctions on Russia. What that means is that the U.S. is going to sanction countries that buy oil from Russia. Now, if you look at this chart, you can see that that's largely India and China. Now, the U.S. already put large tariffs on India, 25%, seemingly in part in response to India's close relationship with Russia. And China, the US really can't push China around, but we know that they're not good friends either. So these are sanctions that would have a big impact on the global markets because although we put sanctions on Russia over the past few years, there were a lot of loopholes in them such that they didn't actually impact the oil market all that well. There's a huge black market there. Now, if the US really were serious to try to enforce these sanctions, there are, I think, big ramifications for oil, for trade, and of course for geopolitics. And it looks like the US is getting more and more serious in hardening its stance towards Russia. So I think that's some tail risk the market isn't appreciating. We did see oil respond to this a little bit, but the overall risk markets don't seem to be responding too much. So I think that's something that we should focus on this coming week. After all, the trade deal was over, and now we're going to find out in the coming months just how big of an impact it's having on our economy. All right, so that's all I prepared for today. This week, we did also have the Treasury refunding announcement. Not super interesting, but I think it does show a little bit about how the issuance structure could change going forward. So that's what I'll write about this week. All right, talk to you all next week.